our next speaker on stage. So Jan de Jik from, please. So yeah, you have time to change chairs or whatever, but then you come back and sit down. Huh? Okay, so Jan is going to talk to us. Welcome on stage. Jan's going to talk to us about ING, ING's view on transition. Jan has been at ING for quite a number of years, very specialised in banking, and we'll hear maybe some of the innovative financing solutions and your ideas on financing, yeah?
Okay, yeah.
Perfect.
Thank you.
Okay, now if you can stop talking, please. Huh? Okay, over to you. Thank you.
Good afternoon, everyone. My pleasure to be here again. The past years, when I was speaking at LuxFlag, we focused on the role of the bank, basically, to support the transition. Today, we have a different agenda. We will start first with a logic of, okay, what happens in the world? So what we call sustainability evolution. Reflecting a bit on the market in 2025. Looking also as a second topic specifically on sustainable finance markets, how the volumes have established across products and regions. And then specifically a topic on transition. What does transition finance mean and how can we look at it from a banking perspective? To conclude with a number of topics as we see it. Sustainability evolution from ambition to action. The word backlash I've heard already quite a few times this afternoon. The question is, what does it mean? Is it truly a backlash, yes or no? We've put a number of pictures which relate back to basically this year, 2025. The first, Mr. Trump becoming president in January 25. Effectively, this picture is from the UN Global Conference a month ago. We also see, of course, as explained by the regulatory guidance, the omnibus package kind of delaying the implementation to certain of changing the scope as well when it comes to CSRD and CS3D. And a few weeks ago, the Net Zero Banking Alliance, which was announced to cease basically its operations, specifically after the members voted against the alliance, but to be continued in the logic of a framework where the guidelines for the FI industry will continue to be available. And most likely working streams within the Net Zero Banking Alliance will continue into the UN FI scope. From ambition to action, we've looked into a number of public reports, the first of which is from Bain & Company from September 25. Interesting, the Visionary CEO's Guide to Sustainability 25. You see the graph starting from 18, basically, till today. You see a backlash in 22, but then again, an increase in the logic of what is the importance of sustainability according to CEOs. This is an analysis done supported by AI, to what extent in public communication sustainability is being quoted, or in public notification through annual reports, investor days, there is a reference specifically to sustainability. If there is a recognition to 25, then the clear guidance is that basically the volume is turned down when speaking about sustainability. However, the action continues. So CEOs speak less about sustainability, but they continue to act. That is what being called the do-say gap in the logic of the CEO quote. In the same report, it also means that initially in 18, at the time, early days to integrate sustainability and finance, typically it was also linked to the UN SDGs, the logic to subscribe to the all kind of moral undertaking to move to sustainability. Today, it's more or less inspired by business value. So companies will look into the logic of operational alignment and to make sure that cross-functional discussions are held on sustainability, meaning also that decisions will have to match short-term focus when it comes to financial priorities, but on the other hand, making sure that the long-term goals on sustainability are being adhered to. Another study from Cambridge focuses specifically on the mindset shift which is required in order to make the change happening. So it has to be embedded as a core business imperative for long-term competitiveness. Next to that, you can't just act alone. We need to act together and transforming whole markets and sectors. Looking at SBTI, everyone knows SBTI. 25 continues to increase versus 24 when it comes to the number of companies and entities subscribed to the logic. Either they have commitments being subscribed to SBTI, or they already have obtained near-term goals, or eventually a net zero and near-term guidance. So the coverage of corporates having kind of this logic towards SBTI continues to increase during 2025. Of course, we see regional splits as already notified. You have to look into sectors and regions. Asia Pacific is also streaming this kind of effort going forward. Within Europe, it's fair to say that there is a boost clearly in Eastern Europe as well versus the overall scope of Europe. If you look beyond SBTI, you can look into data from MSCI. Basically, what are the corporates and companies which have SBTI approved targets, which is the green line, so 18.5%. Then you also can look into, okay, what does it now mean when it comes to companies having company net zero targets or eventually climate targets. Also, 25 versus 24, there we see a continue specifically on the SBTI logic. Decarbonization continues to be focused, and this is a study from PwC, also released in September this year. 12 sectors are being analyzed when it comes to the scoping of what is the percentage of companies who are on track to meet either Scope 1 and 2 or Scope 3 targets. If you look through the 12 sectors, 10 basically have a percentage of more than 60% when it comes to being on track for Scope 1 and 2. So at large, companies have worked already massively on their own footprint and what they buy in the market. Scope 3 is another story, of course, because that's your value chain, upstream, downstream, and it differs significantly per sector. The example of automotive is being quoted. We know more than 80% of automotive Scope 3 relates to their global emissions. So basically downstream focused use phase. In the agriculture sector, it's mainly the opposite. It's the upstream phase of Scope 3, but also Scope 3 represents about 80% of their global emissions. If you see then basically the percentage of automotive, it's 28% of the companies who said we are on track to meet Scope 3 targets. So there is still some work to be done to engage with the supply chain to make sure that that full alignment is there, and hence also the logic of that deep supplier engagement, which is critical as being guided in this study. Energy transition, we've heard also a focus on energy transition at large this afternoon. A study from Bloomberg New Energy Finance continues to increase. Yes, clearly. You see 3 important building blocks: renewable energy, it's the blue bar, which is electrified transportation, and you have the grids, specifically the TSO, DSO logic of energy systems to power up the supply into the distribution and transmission. That is no surprise. But the challenge is, of course, in the other segments of technologies which are more challenging and which, as you see, if you see the data, are indeed also lagging behind because of the underlying difficulty to finance the logic, to have a uniformed approach on the technology itself. And coming back on the first picture, I could have had added also a picture from the IMO, basically. As we know, this week there was the delay in the voting for the IMO for the carbon tax on vessels above 5,000 tons. But also there, we know that technology change is not easy. It's typically dual fuel, but technology is a challenge. When it comes to the banking sector, this is just one slide, but basically there are, if you look through the FIs globally, you can have multiple sets of public commitments of banks when it comes to supporting the transition to a low-carbon economy. Here you see a regional view, European banks, American, Asia Pacific, Middle East. I will shed, of course, the example of ING. We focus on what we call volume mobilized in the transition. Volume mobilized across product categories when it comes to loans, when it comes to capital market transactions. If we structure a finance framework for an issuer, then we will count the volume of the issuance specifically under this methodology. It also means you will have to look into every bank's specific calculation approach, methodology, to make sure you understand the scoping of it, because everyone will have a different view, a different look. Sometimes there is a kind of historic accumulative target. Sometimes they specifically look into the asset commitments which are sustainable. But as guided for ING, we look into cross-product view per year. This has not changed in our view during 25. Also not for the US banks. If we are having syndicated transactions with US banks participating, typically we hear from our clients that they continue to go for mandates specifically on sustainability advisory. However, they will be far less public into their disclosure and into their guidance following the presidency of Mr. Trump. Despite the progress which we have seen in the data shown, there is still a lot to do because global emissions on CO2 continue to rise, as you see here on this picture from the International Energy Agency. The dip is, of course, the Corona dip, but then again, thereafter, it continued to rise. If you look into the marketplace, you have several corporate CEOs shouting, clearly announcing kind of public statements to make sure there is an understanding that corporates and public authorities need to cooperate jointly to make the transition happening. An example of which is the Alliance of CEO Climate Leaders, which was released, I think, 2 weeks ago, ahead of the COP30 in Brazil, to really anticipate governments to act jointly with the industry. So if you look at this, the question is, what does that now mean in terms of sustainable volumes in the global market? And there we typically look at Bloomberg New Energy Finance. A lot of colors, but that basically is looking into the product categories. So the backbone of the market, and it continues to increase, is green use of proceeds. Green use of proceeds, green bonds. First half 25 is again higher than the historic semesters. And eventually on the global market, you see that first half 25 is effectively the highest ever volume in sustainable debt issued globally, which is an interesting notification. And according to our logic, the Q3 data will support that growth indeed also in 25. When it comes to the regional scopes, which is not on this slide, but regionally we see indeed, as explained, a clear increase in demand in Asia Pacific. We see a decrease in the US market, and we see a continued demand strong in continental Europe with a clear growth in Eastern Europe. So despite public headwinds, the sustainable finance market remains attractive, credible and relevant. This is also looking into the Loan Market Association guidance as such, but also specifically looking into, for instance, what does it mean in terms of a sustainability-linked solution, which can be in the loan market or in the capital market. It's clear the market has matured. Companies know how to integrate sustainability and finance with smart KPIs, with annual verification, with sign-off by the board typically to incorporate it in a finance structure. And that shows a resilient market demand. The Financial Conduct Authority in the UK also did an analysis a few years ago and again this year. What does it mean in the sustainability-linked loan market? Clearly, they recognize it's an important feature for the banks to support the transition. Hence, it's being quoted as a logic for supporting transition finance. So that's a bit of update on the market. Next to the global view, what happens in 25. If we then do a deep dive on sustainability and specifically on transition, then I'd like to kind of take the next topic, so concept importance and market evolution on transition. Let me read first the definition of how we see kind of transition. Basically, the financing of entities and/or assets that support an economy-wide transition to lower and/or net zero emissions consistent with the Paris Agreement. It's clear that transition can be funded through green use of proceeds because you have your guiding market principles by the LMA and by the ICMA. Eventually, you do an EU taxonomy cross-check, and you might have a green loan or a green bond, which is EU taxonomy aligned. Multiple examples, but we know that the pool of green assets is fairly, relatively speaking, limited. So to support the net zero economy, we will need to look into transition finance, brown to green for hard to abate sectors, where we will focus on, okay, what does it now mean specifically on certain technologies and certain industries. For that, we have looked into what is available in the market when it comes to transition finance frameworks. This is just an overview. Here we note that the market exists, however, it is limited at this point in time. So various banks have a number of guidances when specific projects or specific industries can be looked at as a transition asset. But also countries have done their homework, like explained, I think, on the regulatory topic as well before. Japan, for instance, was, I think, one of the first with a climate transition bond framework in November 23, issued subsequently a 10-year bond in February 24, because they move away from fossil energy towards clean energy. Coming back to the data before on the global market on Bloomberg New Energy Finance, it is clear that the product sustainable transition finance is only about a limited section into the total volume, so only about 1.5% of the total debt. Now, why is that? Because there are a lot of challenges at this point in time. There is not a kind of a true consistency in the frameworks available, what is recognized as transition. The industry guidance I will explain in a minute. When it comes to investors to look at transition, they would question, okay, what is my added value to have a specific label on transition? Whereas I can just also fund the activity without a specific reference to a label. Pricing benefit, as we know in sustainable finance, typically pricing benefit is either a commercial decision or you have the sustainability linked solution where you can basically differentiate if KPIs are met to give a pricing discount. And fear of greenwashing. You don't want to basically have a transaction being supported in the logic of transition and then being named basically a greenwashing asset. When it comes to the industry guidance, on October 16th, last week, the LMA published a specific guide on sustainable transition loans, the Transition Loan Guide. That's an interesting document because it basically explains first the difference between transition finance, but also financing the transition. When we discuss financing the transition, it's fairly straightforward. We support overall the monetizing and the money flow towards a net zero economy in the full scope of services and products and debt categories available. But the transition finance as such is more specific. You could consider a sustainability-linked loan as a transition finance solution, indeed. Next to that, in the draft document, there are also guidances specifically to look at use of proceed categories, which could be looked at from a transition perspective. The market will evolve. We will see how this will be used in the market by market participants, and then the intention by the LMA is within 6 to 9 months to come out with a final document. It's clear industry drives transition. Underlying to fund the transition, it means that the business case needs to be there as well, and the support to the logic of our clients. Let me explain as well what we do as ING linked to transition, because of course the bank, in essence, the key role, what we believe and the key impact we have is through the financing, what we do, or the financing which we don't do. 3 aspects in that logic come forward. Basically, we drive down emissions. Like explained, we will engage with our large clients. We will engage on their logic to support towards a net zero economy. Build Up Sustainable Future, that is specifically looking into what we call transition accelerator solutions like EV battery charging stations, like biofuels, like specific technologies in certain hard-to-abate sectors. We will look in those to support either on a project finance basis or a parent company funding to basically elevate those new technologies. And of course, try to have everyone involved in the transition. On the first point, drive down emissions, what we call Project Terra, it means we look into our asset portfolio for 9 industrial sectors. 9 industrial sectors which are believed to be the largest ones when it comes to the CO2 footprint globally. We will monitor that on a portfolio basis, typically on intensity matrices. Looking at the sectors itself, it's for instance power generation, upstream oil and gas. It's the entire T&L logic. It's automotive, shipping, and aviation, but it's also the heavy, hard-to-abate industry, steel, cement, and the commercial real estate segment. We will monitor the trajectory of each sector linked to a science-based pathway of the sector organization. Shipping, we will look into the IMO trajectory. For energy, we will look into the International Energy Agency, anticipated flow by market demands when it comes to fossil fuels 2030, 2040. It means that we have also made clear statements into the energy segment to move away from certain upstream clients, for instance, by 2040, because that is also the guidance from the International Energy Agency. It's engagement-driven. We will discuss with our clients to understand where they stand in their trajectory and to make sure that we align on the logic when we have specific loan demands or when we have funding requests from our clients. Science-based also means that we as a bank, as ING, we have a sign-off on these trajectories for these 9 sectors by the SBTi, and we are one of the first, I think the first international global systemic bank having a sign-off by the SBTi on this portfolio view. Next to that, when talking about transition, it's important to really understand what is now the client doing in their transition. For that, we look into public information, and ING has made up a specific client transition plan based on public disclosure by the client and looking into a number of factors. You see that basically on this slide as well. So historic emissions are being looked at. We look at targets which are being set across the ESG logic for the corporates, the action plan to reach the target, and what is the overall ESG governance structure. Underlying, there are a number of questions with weighting factors which result in a score from 0 to 10. We will make this exercise annually. It will be updated. We will have a track record of a number of years. And on that basis, we will perfectly see what is the evolution of a client based on their public information. We will go into a meeting, discussion, engagement, understanding, is this correct? Are there items which are not public, which you want to guide to us? And what is your basically plan for the medium future? Eventually, what is also your underlying funding requirement when it comes to your abatement curve, and what is the logic where ING can support as being a financial advisor? So that's the part on ING, specifically looking into the asset portfolio through Project Terra, but also the client transition plans, how we engage with clients on this logic. To conclude, if you look into the 3 topics discussed today, I would say that first, sustainability, in our view, is maturing to a new stage of action. And it's certainly not a linear pathway. That's one item. Second, it's about innovation and cooperation to drive the effective transition. Meaning not only from an industrial corporate perspective, but also with support from governments and politicians. So that's also an important one. And scaling the transition. Next to green use of proceeds, we will have to also fund transition specifically and make that gap clear to continue towards the overall goal of climate neutral and net zero by 2050. With that, I would like to open up for questions.
Thank you very much, Jan. So it's good to hear something from a banker. We've heard a lot from asset managers, and now we've heard something from the banker. So, questions? Yes, we have a question. Thank you.
Hi, Jan-Philippe Wassenaar. You mentioned briefly, I think, the LMA and those kind of things. Now, there's been quite a few initiatives over in the past where then, let's say, the banks were only, or the clients of the banks had not been told what data the banks need. And do you see a role for the LMA to basically define a data template that each LMA loan needs to comply with? So you can actually, not just for sustainable loans, but just for LMA standard loans, that at least you have data across the universe. You can benchmark, compare, do a competitive analysis, and just all that stuff is now in 200 or 500 different templates, individual disclosures, all that kind of stuff. LMA has basically the power to say, well, an LMA loan needs to have this data quality on these items. Do you see something like that as a...
Yeah, I think that's an interesting one indeed. The LMA guidances, specifically when it comes to sustainable finance, are merely frameworks or market standards, but are up for interpretation. And every bank typically will have their own committee, will have their own procedures, policies to substantiate that further. And there we have seen a clear evolution the past years. So banks are really looking thoroughly in all possible structures. But when it comes to the question on LMA specifically, let's see how that will evolve, and also looking forward to the final version of the transition plan guide. Yeah.
And I guess we need to be careful that the banking industry doesn't end up with what we have in the fund industry, which is the EET, which is this template which needs to be completed for every fund if they want to be distributed, which goes to the distributors, which has, I don't know, somebody in the room probably knows, something like 600 data points, ESG type, plus extra data points, which I think is very useful, but it's also a burden on... Yeah.
It doesn't help, huh?
Yeah, I know. Any other questions? Yeah, we have a question here, please.
Hi, thank you for sharing your very concrete goals towards the decarbonization trajectories. I was wondering, when you were mentioning that you see very little investor appetite for transition finance, if you could share maybe some of your discussions with these investors, and what is their underlying rationale for that? Do they see, for instance, transition as a core part of business competitivity and survival? And also when you mentioned that the only possible benefit is perhaps through sustainability-linked loans for transition finance. I mean, where do you see the value creation coming from to pass on that premium to the transition finance? Is this coming from the, for instance, decreased costs of insurance premiums, for instance?
Yeah, thank you for the questions. Indeed, I refer to the logic that when it comes to transition finance, that we see limited volume in the market because of a number of constraints. One of those is a limited investor appetite. That is specifically, it comes from our colleagues from Sustainable Markets as such. And myself, we don't specifically have direct connection with the investor world when it comes to capital markets or fund business. We merely talk to our corporate clients. But the constraints typically relate to, okay, what's in it for us when it comes to the financial benefit? The bank might label something as a transition finance possibility, but then for a corporate, the question is, yeah, what does that make a difference? Yes or no? And where is potentially the financial benefit to have a loan being structured as a transition loan? The reference to sustainability-linked loans specifically, that is because a sustainability-linked loan integrates sustainability KPIs into the financing structure, which is monitored every year. And as such, it's a progress evolution which is incorporated in typically a facility agreement which can run 5 to 7 years. So with that, you support the transition of the economy. Hence the logic to refer to sustainability-linked loans as being a transition finance toolkit. Yeah.
Any final questions? Okay, thank you very much, Jan.
Yeah, just a quick one. On you mentioned what's in it for the companies. Do you see a role for the regulators or some party like the ECB to make certain transition loans or bonds and green bonds eligible for, say, the liquidity programs, or give them a higher advance rate, something like that, so you basically create an economic incentive,
Yep.
or to cover maybe some of the cost, or create a funding advantage?
That is certainly a possibility, and that would be very helpful in the logic of the entire transition requirement. Today, we all know that there is no kind of imminent analysis available when it comes to climate risk and the impact on the allocation of the capital buffer. So it means when we do a loan, whether it's green or not, the capital requirement for the bank is just the same. Yeah. Hence, the pricing and the transactional return on your loan is indifferent whether it's green or not green. And I think there the regulator, indeed, when there is sufficient evidence on climate risk, that should, in a way, going forward, change so that it can help basically to differentiate the pricing.
Yeah. Agreed. Okay, thank you very much.
Thank you.